On behalf of Bankers Bank, I wanted to thank all the essential workers. That includes everyone here today. Community banking is essential. Also, Bankers Bank would like to thank and have you thank all your friends and families for us that have been performing in the essential worker roles as well. Thank you. Okay, little housekeeping. Today's webinar is being recorded. I clicked start just a second ago. We've allotted approximately 45 minutes, 10 to 15 minutes for each section. We have placed everyone on mute. Please use the chat box to the right of the screen for questions. I plan to aggregate all questions for the Q&A portion of the webinar. If we are unable to get to all questions within our allotted time, we will follow up directly. So the agenda for today's event will be Introduction to Bankers Bank by Brad Stamper, Aspects of Senior Debt by Pete Arsvold, Aspects of Subordinated Debt by Sam Devine, and Q&A. With that, Brad Stamper, the floor is yours.
Thanks, Matt. Good morning, everyone. We appreciate your time today and look forward to providing a quick recap of senior and sub debt. However, I always enjoy telling the story about our unique organization, so I'd like to take a few minutes and give you a brief overview of Bankers Bank. In 1981, a group of community bankers formed our bank because they wanted a correspondent bank that could provide them with products and services to be delivered by an independent provider, rather than a bank that would compete for their customers. Simply put, why do business with a large or regional correspondent bank that's competing with you and trying to put you out of business? Our founders began with the pledge of always your partner, never your competitor. This pledge is one we take very seriously and remain committed to today. Headquartered in Madison, Wisconsin, our company was chartered by 88 community banks as our initial shareholders. Today, Bankers Bank is an $825 million asset bank and has staff and offices located throughout 4 states: Wisconsin, Iowa, Illinois, and Indiana. We deliver our solutions through 7 business lines. Within these business lines, we have almost 70 products and services. I'd like to give you a quick recap of those 7 business lines. First, payments and cash management. When we started in 1981, our very first product line was payments and cash management. Primarily, we offered cash letter settlement. Today, we're proud to be one of the nation's leaders in technology in providing community bank correspondent services. In addition to cash letter and our Own It settlement network, we offer ACH and ACH risk services, complete wire transfer services, including our own wire desk, a comprehensive lineup of Fed funds services, including our agent pool program that currently manages over $3.5 billion nightly. We also provide a complete suite of international services, including international wire, cash letter, and foreign currency exchange. We're also excited to be the first approved bank settlement agent for the Clearinghouse real-time payment solution system. I suggest that if you have an interest or any questions about real-time payments, call us. Investments. This business line has been a major focus of Bankers Bank almost from our very first day. Our services include asset, liability, and risk management solutions and consulting, investment sales and trading, safekeeping services for securities currently at $26 billion in custody, cash sweep, municipal underwriting, and portfolio analytics, including accounting and management. With more than 500 customers, we've completed over 150,000 transactions since 2000. We also provide subordinated debt solutions that you're going to hear more about from Sam in just a few minutes. Residential mortgage solutions. We strongly believe that residential mortgage lending should be a core product and solution for community banks. Our mortgage lineup keeps your bank not only in the residential mortgage game, but competitive. We offer many solutions, including conventional fixed, ARMs, and jumbo loans. I'm confident we have a solution for your needs. Our services also include compliance, digital applications, doc prep, HMDA, and underwriting answers. A couple of trademarks of our mortgage solution includes, number one, when your customer's mortgage is serviced by Bankers Bank, your customer can make their payments at your bank if they so desire. Second, and most importantly, Bankers Bank never sells your customer's data. I don't know of any other service provider in the mortgage world that can make that claim. Commercial banking. Our number one focus in commercial banking is providing bank and holding company financing. You'll hear more about this from Pete in just a few minutes. In addition, we also offer Fed Fund lines, international letters of credit, and loan participations purchased and sold. Bankers Bank is an active purchaser of loan participations from our customers. When you need a partner to complete a loan transaction for your customer, think of Bankers Bank. We also actively sell participations to our customers. A couple of notes. One, we have no minimums. If you need to partner with someone to get a transaction completed, keep one of your good customers in your bank, we're there to assist you no matter the loan size. Second, we never participate 100% of a loan. We never buy 100% of a loan, and we never sell 100%. If you see a loan participation opportunity from Bankers Bank, you know we have skin in the game. Commercial leasing. This area represents one of our fastest growing areas in the bank. We provide a complete solution for you to offer your customers an additional financing option, leasing to your customers. Commercial, industrial, municipal, ag, these are just a few types of industries that we have lease clients. Our unique accordion feature allows you to offer your customers maximum flexibility in financing equipment. Last year, we paid out over $500,000 in fees to our community bank customers, and our lease portfolio is currently around $100 million outstanding. Equipment or municipal leasing is happening in your community, and we can help you participate in those opportunities. Bank cards. We offer both a direct and referral program. We believe that community banks need to have a lineup of superior credit card products, particularly when competing with credit unions and larger banks. Our credit card programs cover both businesses and consumers. We also provide merchant and prepaid card solutions as well. Our bank customers received over $4.2 million in revenue in 2019. Again, Bankers Bank never sells your customers' data. That's really important in the credit card world. If you don't think you can compete in cards, let us show you how. And finally, wealth management. We offer OSJ services to our BFSN network to offer state-of-the-art retail investment program support. In addition, our Wealth Partner Strategies and Financial Planning Group also provides resources for your customers. We're currently managing over $2 billion in assets with our programs. We really feel that with the wealth transfer happening over the next 20 years, community banks need to keep their customers in the bank and not referred to a competitor. Wealth management helps accomplish this. While our mission is to support community banks, we're also a bank. We are a Wisconsin state chartered and Federal Reserve member bank. The Wisconsin DFI and the Federal Reserve Bank of Chicago are our primary regulators. This slide tells our story on our financial performance over the last few years. We're committed to maintaining a well-capitalized bank, and as of year-end 2019, our risk-based ratio was 15.69%, and Tier 1 leverage was over 10%. And just like you, our shareholders expect and deserve a fair return on their investment. As you can see, our earnings per share and dividends have both increased over the last 4 years. One item that I find remarkable about our bank is that when we paid our dividend in 2019, it represented the 39th consecutive annual dividend. As I mentioned earlier, our bank is currently at $825 million in assets. We've enjoyed good growth over the last 4 years. This growth was intentional and supported by our board of directors and shareholders. Just a reminder, all shareholders of Bankers Bank are banks. 9 of our 11 board members are community bankers. As I've often said, if you don't like community banking, you'll hate Bankers Bank. This slide shows a few of our highlights for 2019. To recap a few areas, you'll note that we processed 627 billion in payment transactions, facilitated 176 million in credit card transactions, and provided 435 million in holding company credit. We enjoyed good growth across all business lines in 2019. In summary, we're delighted and honored to call over 550 community banks our partners. With almost 70 products and services, we have solutions for your needs. We're proud to be associated with community banks. We're owned by community banks. Our board is made up of community bankers. We're all in on community banks. Next year, we will be celebrating our 40th anniversary, and we all look forward to providing you with solutions for decades to come. Thanks for your time this morning, and now let's move on to the topic of senior debt for community banks. It is my pleasure to turn the program over to Pete Arsvold, First Vice President and Commercial Banker. Pete?
Hey, Brad, before we transition over to Pete, we did have a quick question in the Q&A as follows. I am not currently a shareholder. Can I become one, and what would the process be?
A good question. The answer is to contact someone at Bankers Bank. You can contact myself, our Chief Financial Officer, Matt Sikowski, or any of our correspondent bankers. We have 8 correspondent bankers throughout the 4 states that we currently operate in, and we'd be very happy to get you information. While we're not currently issuing shares, we have facilitated a number of transactions over the last few years, and I'm confident we can help get you that opportunity. Thank you.
Perfect. Thanks. All right, Pete, floor is yours.
Welcome, and thank you for joining us this morning. I am hopeful that you, your family, and coworkers are well during these unusual times. Since our beginning as a bank in 1981, we have been providing loans to community banks, enabling the purchase of banks, and to provide both long and short-term working capital. We are your experienced and trusted advisor when you need a source for senior debt. This is what we do, and we're very good at it. The slide you see includes information that was just published on June 8th by S&P Global Intelligence. You will see a trend showing an increased amount of capital being raised by banks beginning in February 2020. The increased capital was raised using equity, senior debt, and subordinated debt. The S&P article states, banks raised more capital in May 2020 than any month since the great financial crisis as depositories sought to shore up their balance sheets. You'll see in May 2020, banks raised $21.4 billion of capital. This compares to only $6.1 billion raised in May 2019. When you look at the chart for April and May 2020, you will see that senior debt continues to be the most common way to raise capital. I appreciate that, since providing senior debt is my forte. You will also notice that raising capital using subordinated debt appears to be gaining momentum. Sam Devine will be talking with you in a few minutes regarding subordinated debt. It appears overall that many banks are choosing now as a good time to be raising bank capital. My portion of today's presentation will feature senior debt aspects. There are many uses for senior debt. The first is acquisition financing. In June of last year, I received a request from a bank customer wanting to purchase a nearby community bank. The loan amount needed was $6,900,000. Our credit staff and I analyzed the request, and the loan was promptly approved. I notified the bank president of the approval, and he extended an offer to purchase to the seller. After some negotiations, his offer to purchase was accepted. Then the application was forwarded to bank regulators for their review and approval. It was helpful for the bank financing to be pre-approved, both when extending the first offer to purchase and when sending the paperwork into regulators for their review. Good news, the regulators liked the request, the purchase was approved, and the acquisition did occur in fall of last year. Another use for term debt is capital injection to subsidiary banks. In August of last year, I received a request for a $6 million term loan with plans to downstream the capital to the subsidiary bank. The bank was planning to increase their lending activity, and the additional capital perfectly met their needs. Additional purposes for term debt include bank building expansion, renovation, and technology upgrades. Regarding features of term debt, please know the conditions are very flexible. We will structure the loan to meet your needs. Principal and interest payments are usually paid quarterly. Amortization can be as long as 15 years. There's never a prepay penalty. The loan is secured by bank stock, and there are reasonable covenants. Our next loan type to be discussed is senior revolving credit. A common use for credit lines is simply described as to provide short-term working capital. The uses here are many. Lines of revolving can be advanced and dispersed, repaid and readvanced as often as you like. Another use for credit lines is to repurchase treasury stock. In March of this year, I received a request to fund the purchase of 1,300 shares of treasury stock. A bank shareholder was in poor health and requested the repurchase of his stock. Bank president contacted me. The loan amount needed was $423,000. In only 2 days, the loan was approved. In only 2 days later, the repurchase of treasury stock occurred. The customer was grateful. The bank president responded to me later saying that plans are to upstream dividends to the bank holding company level, enabling that credit line to be repaid in the next 2 years. We have recently received requests to disperse credit lines to fund expenses related to COVID-19. With many people working from home, There were expenses in 2020 that were not budgeted for, and the line of credit worked well. Laptops and printers and other equipment needed to work from home were purchased using the credit line. Lastly, having a credit line is a way to improve your liquidity ratios for both internal and external reporting purposes. I haven't yet met a bank examiner who didn't appreciate your bank having access to multiple forms of liquidity. As far as credit lines are concerned, please know the terms and conditions are very flexible. We will work with you to meet your needs. Interest-only payments are monthly. The loan is secured by bank stock, and there are reasonable covenants. Oh, sorry. There's one important aspect of senior term debt when you borrow from Bankers Bank. There are no fees. This includes both term debt and revolving credit lines. No fees. In closing, please know that Bankers Bank offers you commercial experience you can trust. This includes nearly $500 million in senior debt commitments with over 100 different facilities with nearly 100 individual banks. Your application will be serviced by dedicated bankers. Please contact us with any questions regarding senior debt. We look forward to hearing from you. We will make every effort to meet your needs. Sam Devine is our next presenter. He will be discussing the many aspects of subordinated debt.
Thank you, Pete. Good morning, everyone. To start out my section today on subordinated debt for community banks, I would first like to begin with a story of how the investment department at Bankers Bank first became involved in raising capital for community banks. An Iowa Bank customer came to us in late 2001 looking to raise capital to support their growth plans. They said they were presented with a new capital raising instrument called Trust Preferred Securities by another firm that would provide their bank with Tier 1 capital for 30 years. The only problem is that the fees they were charging seemed prohibitive. So they asked us if we could do it instead. Now, this is a bank that we had worked with since they opened their doors as a de novo bank. So we really did want to find a way to help. After some serious research, we decided that being in the business of providing capital to our community banks while also offering quality investment options to our other bank customers at the same time seemed like a win-win situation. So that is exactly what we decided to do. From 2002 through 2008, we were the private placement agent on 32 separate trust preferred security offerings, providing over $222 million in new bank capital. Many of our larger, more successful bank customers today are the same banks who raised capital during that period. When the financial crisis took hold in 2009, the era of trust preferred securities issuance ended, and it was replaced by subordinated debt. The good news is that subordinated debt securities are much less complicated and much easier to issue. Just like companies like JP Morgan Chase Bank or Walgreens issue corporate bonds periodically, your bank can issue subordinated debentures to raise capital. We have seen more interest in sub-debt recently, especially from smaller community banks, and I believe it is due to the current environment. So far, even though there are a lot of uncertainties regarding the economy, bank credit quality remains strong. Interest rates are still near historically low levels, and the unprecedented level of bank liquidity today has increased the demand from potential investors. Here are the 5 primary uses we have been seeing for the issuance of subordinated debt. First, to acquire another bank or bank branches, to refinance existing debt, to repurchase bank stock, increase Tier 1 bank capital for organic growth, and lastly, to increase Tier 2 capital at the bank holding company level. So why would you look at sub-debt issuance versus other capital raising options? First and foremost, it's all about cash flow. There is no amortization of principal, which allows the bank to use more capital for longer. And that really is a key point. This is the primary reason that banks choose to issue sub-debt versus getting a term bank stock loan. As you run your pro forma cash flows based on your new strategic plan, it may make sense to have longer term financing locked in with zero amortization for maybe 10 or 15 years. Other benefits to sub-debt: issuing banks do not need to provide any collateral like bank stock. There are no financial covenants associated with issuance. Interest payments are tax deductible, which lowers your overall cost of capital. And unlike common stock, issuing sub-debt does not dilute current ownership. To qualify as subordinated debt, each issue must have the following 5 characteristics. First, it must be unsecured. Next, it must state that it is not a deposit or insured by a federal agency. The maturity must be greater than 5 years. It can only accelerate principal payments in the event of bankruptcy or receivership. And it cannot link credit-sensitive features to interest payments. These are fairly reasonable qualifications, I would say. Once you meet those 5 requirements, you do have flexibility to structure your issue the way you'd like to. But we do see similar characteristics in the marketplace. For instance, the vast majority of issues have 10-year final maturities. We have seen a few issues go out to 15 years as well. There is generally a fixed interest rate for a period of time, and that's floating rate thereafter. For instance, if it's a 10-year issue, has a fixed rate for the first 5 years and a floating rate for the second 5 years. Issues are usually callable after 5 years at the issuer's option. There are interest-only, quarterly, or semi-annual payments. The notes can be physical or in DTC book entry form. The process for issuing sub-debt will take roughly 60 to 90 days from the time you decide to issue until the funds hit your account. There are 6 primary steps along the way. First of all, you're going to discuss your plan with your regulator. Next, you're going to sign a private placement agreement with a firm like Bankers Bank. Next, you're going to work with a law firm to produce disclosure documents. For legal assistance, we certainly have law firms that we can recommend to assist you. If you have your own that you want to use, that's also just fine. Just remember that using someone that has all the paperwork and documents in place will probably be easier and less costly. Next, the placement agent is going to place the issue with investors. This can be a quick turnaround with some banks. Some other banks will treat these as loans, so it'll go through loan committee or possibly even through the full board for approval. Next, both sides are going to execute the subscription agreements. And finally, settlement of the issue. There are typically just two costs involved with issuing subordinated debt. One, there's going to be a private placement agent fee, which will be a percentage fee based on the par amount that you issue. And next, there'll be those one-time legal fees to pay for all the disclosure documents. So why would it make sense for your bank to issue subordinated debt through Bankers Bank? As Brad often says, and said again today, we are all in when it comes to community banking, and we are. We know how to analyze bank credits. We know how to structure deals that will be successful in the marketplace. Our investment department has a unique distribution capability based on all the relationships we've built up for decades. I really believe that community banks are the most logical buyers of bank sub-debt. And we have more bank relationships than anyone in our market. Also, just as we have done with thousands of municipal deals, we know how to highlight the key metrics of an offering so our customers can make an informed decision. As I mentioned earlier, with our success with trust preferred securities, issuing sub-debt, that process is much, much easier. We also will not be requiring any ratings for issuance, so you can save on the cost and time of that process. And lastly, operational efficiencies. Whether you do these as physical notes, there's a good chance the issuing bank and most or all of the investor banks will all have accounts at Bankers Bank to streamline that process. And if you decide to go the DTC book entry route, Bankers Bank has a direct relationship with DTC. To wrap up this section on issuing subordinated debt, I want you to take away 3 key points. Number 1, issuing sub-debt is a relatively easy, quick, and low-cost way to raise capital for your bank. Next, right now is a good time to issue sub-debt. And lastly, Bankers Bank is perfectly positioned to make your sub-debt issuance successful. Thank you for your time and attention this morning. I really do appreciate it. I'll now turn things back over to Matt Ladio.
Thanks, Sam. So before we jump into the Q&A, I would like to take a minute or two here and kind of put it all together. So we had a community bank recently approach us discussing finance for a potential acquisition. As one of the examples Pete mentioned, the deal looked like a good fit for the community bank, and they were very excited to proceed with it. They indicated that they would need 10 to 13 million, depending on a few variables. Based on the commercial banker knowing the bankers for many, many years, we started talking senior term debt and what that would look like in today's environment. We then presented a combination of senior term debt and a revolving line of credit. Again, having both provides flexibility where the revolving line of credit could be used for part of the acquisition and additional liquidity. At this point, the deal was financed, but we wanted to make sure that all the options were explored, and that is when we discussed subordinated debt. The community bank was really intrigued. They talked about how it would fit into what they were looking for and how they wanted to work the deal. That is when we brought in our investment group and Sam Devine, and we walked them through all the aspects like we did today and all the benefits. They did not know that you could get all 3: senior term debt, a revolving line of credit, and subordinated debt at Bankers Bank. So that is what we put on the table, a combination of all 3. We provided senior term debt in the amount of 7.5, a revolving line of credit of 3.5, and subordinated debt of 4 million, which covered their acquisition purchase price of 13 million. So before we hit the Q&A, again, I wanted to leave you with the impression that from the standpoint of being able to provide all 3, we are very, very unique in that ability. With that, we do have a few questions and answers, and we will start with those. So here's a question for either Pete or Sam. Is senior debt more expensive than subordinated debt? And how would you compare the costs?
I'll take that one, Pete. So as you're comparing the senior and sub debt, I mean, certainly with senior debt, let's just say with sub debt, you're going to have some upfront costs versus senior debt. And generally speaking, you're going to pay a higher interest rate. So you say to yourself as a bank, well, I said this to myself, why would I do that? The reason's simple. With sub debt, it's more capital for longer. And that's the way you want to think of it. And that's why sometimes the mixture of the two can really work well together. And remember as well, I mean, just as the name suggests, right, it is subordinated debt. So you're a little bit lower on the credit scale. You don't have the bank stock as collateral. So again, just to summarize, sub debt's going to be a little bit more expensive, but it's capital. It's more capital that you're going to have for a much longer time period with no principal repayment.
All right, great. So here's a follow-up question. And I think if we go back to Pete's slide earlier that showed all the yellow and the senior versus the sub, it appears most of the questions will kind of be towards you, Sam. So is it issued at the bank holding company or is it issued at the bank?
It generally is issued at the bank holding company level, but in a lot of cases then, after issuance, they'll downstream the issue as capital down to their subsidiary bank.
Very good. As we heard, so this kind of plays off of earlier in the presentation. Are there any minimums to subordinated debt? So we heard that on the senior or the commercial side, there are none, but what about the subordinated side?
I would say there's no written laws or rules regarding that. It's more in terms of practicality. And I would say because there are some upfront costs that you need to pay, I would say somewhere around $3 million is a practical cutoff, meaning that if you're looking at something less than $3 million, you could probably call Pete and get some a better solution that way.
Good point.
But once you get over $3 million, definitely sub debt can be part of the puzzle.
Good. Another question for Sam. Do you see subordinated debt being used to replace trust preferred? I guess that could be a Pete question as well.
Yeah, I think, banks have, financing coming due all the time. We can see that. And so I think really as these bank holding companies have, debt maturing or it's coming up in the next year or two, you want to analyze the senior debt and the sub debt always and see which is a better fit. And again, our ability to issue a combination is extremely unique and maybe the best answer.
Good. What if, here's another one, Sam. What if we want to have a friends and family approach to issuing subordinated debt? Could you describe the marketing efforts that go into issuing subordinated debt?
Certainly, yes. How we do it here, it's not a broadcast situation. Okay, you're not going to find a sub debt offering on our morning update that goes out to 1,000 bankers. No, we kind of, of all the banks we work with, we kind of know who's a good fit. We make targeted calls to specific banks to discuss these deals. We know who's interested, we know who's not. And in working with each individual issuer, we can customize it so if there are certain banks they would like to see it, a priority, we can certainly do that. If they want to exclude some banks, we can also do that. So it's really customized and tailored to their needs.
Okay, and then so here's another question. How would I get on the list for when you have subordinated debt deals to market?
Yep, I would, our investment officers here will be happy to talk to any of you. So if you normally talk to someone in the investment department for your investment needs, just reach out to that person. If you do not, please contact me.
Okay, great. And then as we approach our 45-minute time limit here, we do have a few more questions that we didn't get to. we'll respond directly to those. We do have one last one that we'll follow up with Sam. And then, we will have an information packet of today's presentation to share with all the participants. So last question before we wrap up here. Sam, where currently are you kind of seeing rates for sub debt?
Yep, right now in this environment, it's right kind of in that 5 to 5.5% for the fixed portion. And then as you get to the floating rate, there's still some deals that are getting spread over LIBOR and some banks that are getting spread over the new index SOFR. And those are generally, in the plus, let's say, 350 to 450 range.
Super. So here's contact information. If you have any questions about today's presentation, feel free to reach out to Pete or Sam. You can always reach out to Brad or myself. Also, you can reach out to anybody in your in-market teams for your commercial correspondent or investment bankers. As always, we'll visit with you as often as you will have us let you visit with you. So please feel free to reach out if there's any questions on today's presentation. And with that, I would like to thank our three presenters today. And I would like to also thank everybody for their time today and hope that everybody has a great banking day.
Thank you.
Thank you.
Thank you.
And with that, the event has ended.